In the next few minutes, you'll learn how to legally save a ton of money on taxes with cryptocurrency, even if you're a complete beginner. Many new crypto investors unknowingly overpay taxes or make costly mistakes because they don't understand how crypto is taxed. But today I will break it down step by step in a way that's simple, legal, and easy to apply. And make sure to watch until the end, because I will reveal one secret tax strategy that even experienced investors forget about. Let's get started. Alright, let's dive into the basics. Before we discuss tax-saving strategies, it's crucial to understand how crypto is taxed. Here's a key fact. Crypto is taxed as property, not as currency. This means that every time you sell, trade, or spend crypto, it creates a taxable event. So, when do you owe taxes? You owe taxes when you sell crypto for cash, for example, selling Bitcoin for USD. You also owe taxes when you trade one crypto for another, like swapping Ethereum for Solana. And yes, even when you use crypto to buy something, even a coffee, it creates a taxable event. You don't owe taxes when you simply hold crypto without selling, transfer crypto between your own wallets, or buy crypto but don't sell it. Now that we know when crypto is taxed, let's talk about how to reduce those taxes. Step 2. Hold your crypto for over a year for long-term tax benefits. One of the easiest ways to pay less tax? Just hold your crypto longer. Short-term versus long-term capital gains. If you sell within 1 year, you pay short-term capital gains tax, which is often higher, up to 37% in some countries. But if you hold for over 1 year, you pay long-term capital gains tax, which is much lower, sometimes as low as 0 to 20% depending on your income. Tax-saving tip: if you don't need the money, immediately hold your crypto for over a year before selling to significantly lower your taxes. Example, you buy Bitcoin at $30,000 and sell it at $40,000 within 6 months, you'll face a high tax. But if you buy Bitcoin at $30,000 and sell it at $40,000 after 14 months, you'll have a much lower tax. The key takeaway: patience can literally save you thousands in taxes. Step 3. Use tax loss harvesting to offset gains with losses. Most investors forget that losses can actually reduce their tax bill. What is tax loss harvesting? If some of your crypto investments lost value, you can sell those losses to offset your taxable gains. Example, you made a $5,000 profit from Bitcoin, but you lost $3,000 on Solana. If you sell your Solana, you can offset your Bitcoin profit. Instead of paying tax on $5,000, you now only owe tax on $2,000. Smart move. Before the year ends, check your portfolio for any losses and strategically sell them to lower your tax bill. Warning: be mindful of wash sale rules. Some countries don't allow you to rebuy the same asset immediately after selling. Step 4. Consider moving to a crypto tax-friendly country. Did you know that some countries have no crypto taxes? Alright, let's talk about some crypto tax-free countries. First up, we have Portugal. Here, there's no capital gains tax on crypto. Next, the UAE offers 0% tax in certain free zones. El Salvador also has no capital gains tax on Bitcoin. And finally, Singapore, where there's no capital gains tax as well. Now moving on to an interesting strategy. Step 5, donate crypto to charity. It's 100% tax deductible. Instead of selling your crypto and paying tax, you can donate it to a registered charity and get a tax deduction. Pretty neat, right? For example, by donating crypto to a registered charity, you're effectively lowering your taxable income for the year. This means you'll pay less tax on your other investments or income, including wages, business profits, or any other assets you own. Step 6. Use a crypto tax software to track transactions. Most beginners make a huge mistake. They don't track their transactions. Crypto tax rules require detailed records of every trade. Instead of manually calculating everything, use a crypto tax software like CoinTracker, Coinly, or Crypto Tax Calculator. These tools automatically track your trades and help you find tax deductions, saving you hours of work and thousands of dollars. Step 7. Invest in crypto through a tax-advantaged account. Want to pay zero taxes? Consider using tax-advantaged accounts like self-directed IRAs for US investors and crypto-friendly retirement accounts. Example, if you buy Bitcoin inside a Roth IRA, your gains are 100% tax-free when you withdraw in retirement. If you're planning for the long term, this is one of the best ways to legally grow your crypto tax-free. Now you know how to legally save thousands on crypto taxes. Want more? Subscribe for free educational crypto videos, top weekly crypto news, and how to avoid scams in crypto. Hit subscribe now and turn on notifications so you never miss an update. Comment below if you have any questions or want more crypto tax saving tips.